Alright, so name of the reading now is Inventories. There have been major changes in the learning outcomes of this reading for 2016, and they have moved a lot of learning outcomes from CFA level 2 to CFA level 1, and therefore this might be one of the tougher readings in the syllabus now. So I'm going to follow a learning outcome approach where we will go one learning outcome at a time. So I'm starting with the first learning outcome, where we have to distinguish between cost included in inventory versus cost recognized as expense. So the one cost that we would definitely include in the inventory is the purchase cost. So if you buy some raw material, then that raw material is definitely going to be a component of your inventory cost. What we would also include in the inventory is the conversion cost. More specifically, the word in the curriculum, we use the word direct conversion cost. You think in the context of a manufacturing firm. So a manufacturing firm will typically have its inventory broken down into three parts, which would be raw material, work in progress, and finished goods. So the difference between raw material and work in progress is, in this phase you have started processing on your inventory, right? So processing could be either machine based or human based. So all that cost that you incur for processing, which typically is electricity, other overheads, and the labor cost, that is loaded or included in the cost of work in progress. In this phase you start packaging and other components, and then we will typically classify them as finished goods. So generally the rule of thumb is, from the time you purchase the inventory and then till the time it does not reach your point of sale. So point of sale could be your showroom. All the costs that you incur in the context of inventory is included in the inventory cost. So when you buy a raw material and you incur transportation costs to transfer that raw material from the vendor's place to the factory, even that transportation cost would be considered as a cost included in inventory. What is not included in inventory is, number one, period cost. Can you think of a period cost scenario? Sorry?
Maintaining your inventory in the
warehouse. So rent that you pay for the warehouse, that's a period cost, because irrespective of the quantity you manufacture, you have to pay the rent. So it is assigned to 1 month or 1 year, so that's why it's a period cost. What we do not also include is abnormal losses. What we do not include is abnormal losses. Okay, so let's do an example to understand this concept of abnormal losses. So first time I got to learn this first hand when I had visited the factory of Cadbury India. So they have a plant here in Pune, in area called Induri, and all the less priced Cadbury chocolates are manufactured in this particular plant, and all the expensive chocolates are manufactured in the Thane plant. So typically the way the production of these chocolates happen is that there are several lines. There is a multiple round of processing that the raw material goes through. So typically if Cadbury, typically if they put in about 1000 kgs of raw material, by the time that is converted into finished goods, it turns out to be just, I'm just making up the numbers, it just turns out to be just 800 kgs. So what happens is that 200 kg is lost in the manufacturing process. It could be evaporated or whatever process that went through. So raw material turns out to be 800 kgs. Now let us say the valuation of this 1000 kg was 80,000, ignoring all the overhead cost. We will say even the finished goods or work in progress is worth 80,000. That means we completely ignored the loss of 200 kgs, because this 200 kg would be considered as a normal loss. That is a normal manufacturing convention for this particular line of business, that you would end up losing about 20% of raw material that you put into your manufacturing process. So normal loss is not considered for accounting purpose. Now think of a particular scenario where the company inserted 1000 kgs into the process, and then there was a loss of electricity or something else that happened during that particular line of production, and therefore they had to restart the entire process again because there's a lot of heating and cooling process involved. So maybe during that particular line of production or that particular lot of production, the output turned out to be only 700 kgs. So now what we will say is that your normal loss is 200 kg, which we ignore, but your abnormal loss is going to be of 100 kg. So it would be wrong to show that 700 kg at a price of 80,000. What we will say is that this 700 kg is to be shown at a price of 70, and remaining 10,000 would be shown as an expenditure, and we would call this as abnormal loss. Are we clear with this? So what we do not consider for accounting purpose is the normal loss, but abnormal loss is to be considered, and that is to be shown as an expenditure in the period in which it is incurred. Are we fine here? Next learning outcome, different inventory valuation methods. So this part we have already made a reference when we went through income statement reading. So in US GAAP, allowable methods are LIFO, FIFO, weighted average, and specific identification. In IFRS, is LIFO allowed? No. So except LIFO, all other methods, we have FIFO, we have weighted average, and we have specific identification. So LIFO is last in first out, FIFO is first in first out. May I assume that you would have a reasonable understanding of this? So what we would do is we would still do LIFO and FIFO, but in a slightly different perspective now. So I'm building an example, and this example is going to be extremely useful when you revise this particular reading. The heading here would be perpetual versus periodic system. Perpetual versus periodic system. Okay, these are two inventory accounting systems. So how you want to think is that if you're using, so these are our two accountants. This is accountant for the perpetual system. This is accountant for periodic system. If you're using periodic system, then your accountant is on Red Bull. So accountant is on Red Bull would mean that your accountant is hyperactive. The lot of caffeine on his body is helping him, is pushing him to record the entries the moment transaction happens. Whereas if you're on periodic system, then your accountant is on, so you can fill in the blanks, and then his functioning is extremely slow. So he would not book the entries right at the time of transaction. He might book the entries at the end of the year. Now let's put this into numbers. So let us say we have a scenario like this during the year. This is 1st of January. This is the quantity. This is price per unit. So quantity purchased is 100. We purchase at a price of 10. Let us say now it is 1st of March. We purchased quantity of 400 at a price of 20 per unit. Then on 1st of July, we sold 400 at a price of 50. And on 1st of December, we purchased another 400 at a price of 30. Okay. Then the organization has decided to use last in first out method, LIFO, but two different accountants are going to look at this LIFO from a different perspective. So one of them is on perpetual, one of them is on periodic. What we want to calculate is what would be the COGS, what would be the ending inventory. Now observe this carefully. In perpetual system, since your accountant is so active that he would want to book the entries right on the date of transaction of sale, which is of 1st of July. So he will say we have sold 400, which were the last in first out goods, the ones that we purchased on 1st March. So therefore he will say COGS should be 8,000. Are you following this? And then what would be the ending inventory? Now ending inventory for the end of the year, not on 1st of July. So ending inventory will have this 100 into 10, which is 1000, plus we will also have these 12,000. So your total ending inventory now 13,000. Are we okay here? Now observe what periodic accountant does. The whole year he was under the influence of whatever substance. So therefore he decides to book the entries at the end of the year, which is 31st of December. So he doesn't care about the dates. He says last in first out, which were the last goods to be purchased. The last purchase was 1st December. So he will say COGS 12,000. And therefore ending inventory is what is left here, which is 8,000 plus 1,000. 8,000 here, 400 into 20. And your ending inventory here would become 9,000. So periodic system versus perpetual system of inventory management. Any questions here? Please write down this example. Let's look at Fifo now. So again, this is going to be interesting. Again, this is perpetual and this is periodic. Okay, I want you to observe. I'll give you time to write. Now, first in, first out, the accountant is trying to book entries on 1st of July. He will say which were the first 400 quantity purchased. So first 100 will come from here, which is, and then 300 will come from here, which is 6,000. So your COG is 7. And then what is left with us? So 100 is left out of this 400, which is, and this entire 400 is left, which is 12,000. So this is 14 and this is 7. Are we okay? Look at what periodic does. He's booking the entries at the end of the year. He will still worry about which ones were the first ones to be purchased. So 100 will go from here and 6,000 will go from here. So this would be 7,000, and ending inventory is exactly same, which would be 14,000. So what you want to appreciate here is that when you are on FIFO method of inventory, then whether you use perpetual or periodic, it does not make a difference. The amount of inventory is going to be precisely same. Even if you carry forward the inventory, since your ending inventory would be same, your opening inventory would be same. So no matter what scenario you try to do this, in perpetual and periodic, if you're using FIFO, the intuition behind this is you cannot sell something which you do not have. And because you cannot sell what you do not have, the values would always be same, irrespective of perpetual or periodic. Are you fine here? Let's do weighted average. Now the weighted average inventory. So this is perpetual. This is periodic. Now this is slightly tricky, so you need to be a little careful here. What you do with perpetual, since you're booking the entries on 1st of July, the average is to be calculated on this date. So you will say, what is the total amount I have purchased so far? 1,000 plus 8,000. 1,000 here, 8,000 here. Divided by what is the quantity I have purchased? 500. So on an average, what is the cost at which I have purchased my inventory? Is it 18? Please cross check. Is it 18? So 1,000 plus 8,000 divided by 500. Your average cost is 18. So your COGS will be 400 into 18, which is how much? 7,200. And then what would be your ending inventory? Ending inventory is whatever is left. So you're left with 100 from here at a cost of 18 and 400 here at a cost of 30. How much is that? Is it 13,800? And therefore the total of both is going to be 21,000. Do you want me to repeat this again? Have you understood this? Please be honest. Do you want me to repeat this again? So assuming you've understood this, let us find out how to do accounting for periodic system. I'll give you time to write. Observe, if you miss this, it is going to be difficult to pick up later on. In periodic system, the accountant is booking entries at the end of the year. So we will look at what is the total purchases made for the year, which would be 1,000 plus 8,000 plus 12,000, which is 21,000. And what is the total quantity purchased? Total quantity is 900, and therefore your average price 23.3. So on an average we have made purchases at 23.3. Then your COGS would be 400 into 23.3. How much? 9333. And your ending inventory would be, how much are we left with? 500 into 23.33. So that would be 11,666. So that total comes out to be 21,000. That is weighted average periodic system. So your ending inventory is always, in this example, 21,000 minus COGS, because that's the total purchase we made. So this is a bifurcation. Whatever is left into average divided by 400 into 30. Sorry, added 400 into 30.
Does it mean that in except LIFO, everything else, your inventory and other things are same?
Except FIFO. Except FIFO, your COGS and ending inventory would be same, based on whether you're using, did I say same? So FIFO, your inventory values would be same, but LIFO and weighted average, they would be different. Are we good to go ahead? Now, if you, let's say you go shopping to a grocery store, a large grocery store, what method you think are those people using? Are they using FIFO or LIFO or specific identification? So for most of the components these days, since we have the barcode mechanisms, the method which is used is specific identification, because there is a lot number on every purchase, and then whatever is purchased is automatically sold. But if you're buying vegetables, from the same big grocery mart, then there are no stickers put onto. I think there are stickers I've seen on some of the fruits, but generally on the vegetables there are no stickers. Then the method that would be used would be FIFO. So in India we don't use LIFO, we use FIFO. So depending on what type of product we're dealing with, we would see that different inventory valuation methods are put to use. Are we fine? Next learning outcome. So what we've covered, we're done with A, we're done with B. Now for learning outcome C, I'm going to show you some interesting photographs. This is about Zimbabwe. And the whole story there is that there was a civil war between blacks and whites, and a lot of farmlands were confiscated by one of the other group, and therefore their agricultural production, their production in the whole country stopped dramatically. So since their production fell, they had to import from other countries, and because they had to import, there was a big outflow of currency that was going in. So what the president did, he kept on printing currency, Right? So he kept on printing more amount of currency to support that purchases. And then they reached to a level where the country had reached in a hyperinflationary environment. Right? Hyperinflationary means your inflation is maybe typically for consecutive 3 years, your inflation is more than 28-29%. Then in US GAAP, we call this as hyperinflation because that turns out to be 100% in 3 years. So in Zimbabwe, the inflation rate was at one stage 10 raised to 21, 89.7 into 10 raised to 21%. And then it went to 6.5 into 10 raised to this value. I don't know how is that pronounced, but the inflation was exorbitantly high. And in such high level of inflation, then after some time we know that currency loses value. People stopped accepting currency. So I have some interesting example from those days. Okay, so this is a school kid who's going to buy some candies. Then there is one more. So this is the currency they have used for decoration. It is being put onto walls. And Mugabe was the president of the country then. And yeah, the next one is very interesting. So now if you travel to Africa, then you can buy this currency as a souvenir, right? So if you have I think last time I tried to purchase, you can buy $100 trillion note for about 100 odd US dollars. I mean, you can keep this as a souvenir and then you can say you have $1 trillion with you. Then $100 billion. The last one is the best one. Yeah, so that's, if it's not readable, this is 5 million, this is for 3 million, and I don't know how much is this. Yeah, so coming back to the topic. So hyperinflation can have devastating effect on the economy of a country. And here we want to, now not directly link, but we want to kind of understand what impact will inflation have on profitability of the company, okay, in the context of inventory. So I'm going to build a Zimbabwe-like scenario here. So on 1st January, you purchase quantity of 10. Price per unit was 10 per unit. On 1st July, you purchase another 10, but the price is 100. Okay, this is price per unit. Now during the year, you have made sales of 10 units. And let us say you made that at a price of, let's say 200. So you have made sales of 10 units at a price of 200. So what is your total sales? Total sales is 2000. You want to decide what should be the COGS. And to determine COGS, we'll have to determine which method to use. Imagine you decided to use Fifo. First in, first out. So in Fifo, first in, first out, we will assume which one is sold. The one purchased at a price of 10. So your COGS would be just 100. But if you decided that you want to use LIFO, then the COGS is going to be 1000. Which means depending on the method of accounting you use, there would be a large difference between the profitability of two organizations. Okay, fine. So the next learning outcome, which is learning outcome C, it requires you to find out the impact on gross profit and ending inventory of different inventory valuation method in inflationary and deflationary environment. Okay, so you write down this, then we are going to build a summary table. We cannot determine the question he asked, how will perpetual and periodic inventory affect? So it's difficult to determine because that depends on what is the date of sale and date of purchase. But assuming you had continuous sales during the year, and if your accountant is on LIFO and periodic, it would be more devastating than accountant on LIFO and perpetual, because he'll keep on picking the last purchase dates. So let's build a summary table on impact of ratios. So heading you can give for this table: impact on ratios, and we are going to do this for LIFOs. So here my assumption is inflationary environment. So first number is COGS. What do you think? Inflationary environment, LIFO COGS will always be higher. Then ending inventory. Since the most expensive inventory went into COGS, what is left is the cheaper inventory. So ending inventory would be lower. Then next parameter is your gross profit margin. So because your COGS is higher, gross profit margin is lower. Then impact on taxes. So because your gross profit is lower, can we say taxes would be lower? And if taxes are lower, the impact on cash would be higher. Why? Because you're paying lesser amount of taxes. So if you pay lesser amount of taxes, your amount of cash is going to be higher. Then impact on current ratio. Current ratio would be lower. Why? Because inventory is lower, cash is higher. These are contrasting effect, but the impact of inventory would be higher than impact of cash. Inventory would be lesser by larger amount, cash would be higher by smaller amount, and therefore current ratio would be lower. Then inventory turnover ratio. This ratio would be higher. Why? Because your COGS is higher and your ending inventory is lower. And if we are in a deflationary environment, then everything would be exactly opposite. Right? And on the exam, since both curriculum and the Schweitzer notes, there is an extensive discussion on inflationary environment. On the exam, they would typically ask you what happens in a deflationary environment. Right? So you don't have to remember any of this, just build a thought process on this. So the thought process is that the ones which are purchased last are the ones which are going into COGS. So if you are in a deflationary environment, the ones which are purchased last are purchased at a cheaper price. So therefore your COGS is going to be lower. Ending inventory now would be higher. Gross profit would be higher. Since profit is higher, taxes is higher. Taxes higher, cash is lower. And then we had current ratio. Current ratio would be higher because your inventory is higher, and inventory turnover would be lower because your COGS is lesser, your inventory is higher. Are we good?